Good afternoon. You're watching the newsroom right here on ET Now. I'm Ajaya Sharma. The markets opened gap down today, but over the next 1.5 to 2 hours, there has been a very meaningful recovery from the day's low. And it's not the large cap alone. If you look at the mid caps and the small caps, you would see the recovery, intraday recovery, is much more sharper there, which is a clear sign that buying continues to emerge at lower levels. The areas, of course, where buying is emerging, even Nifty for that matter, is quite significantly trading off lows. Let's talk about how the market is looking, which are the sectors which are hot right now. Where does the value lie? Now, professional money managers approaching the market. Niraj Kumar of Future Generali Life Insurance is joining us today for more on that. Niraj, afternoon. Thanks for your time. I'd like to ask you first about the last 2 months. We saw a reasonable correction which happened in the markets. Broader markets maybe slightly more, benchmarks. So on an average, portfolios did go down 15-20%, which is par for the course in any structural bull run. We've seen it in the past as well. Talk to us about how did you analyze the valuation picture on those lows of say 15,700 and the factors at play, and how did you go about managing your portfolio? Did you add positions, churn, trimmed? What was your working of the numbers?
No, so of course, Ajay, in fact, if you really look at last 2 months, 2 months back, when maybe especially Russia-Ukraine standoff really happened, this actually gives a lot of opportunity for us to basically restructure the portfolio the way we really wanted. So it was something which was a very good opportunity for any professional fund manager or anybody who is really looking at market for a long-term or a medium-term perspective. And clearly, we could really utilize that fall. One thing for sure, it was something which was going to come, that we have seen time and again. This is not something that maybe has happened only once, maybe in last 2 months and 3 months. Market will have its own reason to really correct. Also, we really saw maybe it's not like only one worry that we really have seen in last 12 to 18 months. There has been multiple regions, and market in all those regions has actually at that point of time has really seen a significant fall, maybe to a fall to somewhere around 8 to 12%, depending on which fall they were really talking about. So the first, if you really remember, Ajay, it was actually a year back when the May, somewhere around April and May, we really had the COVID second wave. And we really had some bit of impact on the Indian market as well. So that was another opportunity. Then we really saw, as the year progressed, we saw that maybe another worry which actually emerged, which was something to do with maybe the taper or the taper tantrum that we really, it was reminded in 2013 and 14, this is going to happen and so on and so forth. But market has its own way to really deal with. The fact of the matter, why it is different this time, that perhaps there is one segment which is like liquidity, which is, of course, will really change because a lot of things really happening globally and liquidity tightening is happening. So the new normal in terms of the liquidity would really come. But what is very heartening to really see that in terms of the recovery globally, we really not seeing a significant pressure in terms of the economic activity. As and when we are really looking at the data point, perhaps we really get that maybe confidence that maybe, yes, it is going to get better. Look at India. India will continue to really show this year, maybe perhaps 8.5 to 9% growth. Next year also, we are looking at closer to around 7.5 to 8 as a number. Then in a way, it is actually giving you some sort of confidence to really deploy money and the way you really want to invest in the market for a medium-term perspective. So that's what maybe the opportunity really came, and we were happy to visit. Basically, we took that opportunity.
Niraj, talk to us about earnings growth of portfolio companies. In a blended format, the sector which you are bullish on, what kind of earnings visibility are you getting sitting here for 4 to 8 quarters, especially in light of high commodity prices now, all of that? Have you reworked your numbers lower as well?
So very relevant question, Ajay, that if I look at the Nifty constituents, which is where maybe perhaps most of us would really invest at least 80 to 85% of our money, okay, or at least 75%, is not going to change very materially. So we are not looking at that year at least will really have a significant deviation in terms of the aggregate number. Maybe 2 and 3% here and there, knockoff can really happen. But on aggregate level, we will not really see much of difference in terms of the number. But of course, the component is going to change dramatically. There are a couple of segments where we would really see maybe a decline as high as maybe around 20%, which is quite possible, especially in some segment which is basically going to get impacted from the higher inflation that world over that we are actually seeing. There are certain segment which is metals and the other commodity which is going to show maybe almost 30-40% on the higher side. Okay, and that would really make good maybe whatever we are actually going to lose in certain segment. And then you have some bit of buoyancy, which is the main uh, the structure of maybe the Nifty or the main constituents of the Nifty, which is the BFSI and the entities, which is the bank and financial services. And if you really look at that, is going to get better. We, as of now, don't really have much of reason that we really say that, okay, their number is actually going to get relatively on the lower side, what we really envisaged some time back. In fact, as we really go on, and if you really look at the quarterly number that most of these companies have really reported in terms of at least the headline number in terms of the growth in credit growth, that really gives you some bit of optimism that perhaps this segment, which is almost close to around 40% of the market, is likely to do relatively far better than maybe perhaps what it has done in last maybe few years, last 3 to 4 years. They are also, as a sector, they are coming out from maybe their own worries in terms of maybe the credit cost. So it's coinciding in an environment on a three front. One, of course, the credit growth is actually picking up. The second, it's a rising interest rate, and hence you would really have maybe better in terms of margin, which also augurs well in terms of the profitability. And third is the credit cost. So all three front, it's the segment and the sector is going to fire, and that's something which is really good news for all of us.
Right. Niraj, one last question. Is the market pricing in the total rate hike trajectory for Indian system as well? Because up till now we were in neutral to accommodative stance. Even if the stance continues this policy, obviously at some point in time they will have to align themselves with the global stance as well, gradually, however gradual. What is market pricing in that? Over the next 12 months, how many price hikes? How would equities bake it in?
So first, let me actually answer maybe from the fixed income perspective, then we'll really talk around maybe the equity. So if you're looking from the fixed income perspective, yes, the market clearly at this juncture has priced in maybe around 50 bips in terms of the price, in terms of maybe the hike, the monetary policy hike. But I guess this cycle for India at least is not really going to be a very long cycle. It would relatively be a very shallow cycle. What we really mean that 75 to 100 bips, even if we really have to follow maybe perhaps the global footprint in terms of maybe monetary tightening, the cycle maybe in the global scheme of things could really be 250 to 300 bips. But for India, it could really be not beyond 100 bips. And then that would really be mostly to do with the normalization in terms of maybe the policy stance. And to some extent, market, at least maybe the fixed income market, has only priced in only to 50 bips. So as and when we really get clarity that it is going to go beyond 50, perhaps market would really react. And we are seeing that maybe, okay, from here on, perhaps 30 to 40 bips of maybe the 10-year could really be on the higher side. Let's take here and there, maybe 10 to 20 bips, but broadly 720 to me really looks like maybe peak is at least for some time. Given that maybe the backdrop that we really have from the global front. About India, I think it's not really going to be very material. When you're looking at most of the component, which is basically the Nifty component, which happens to be here in terms of maybe the BFSI, we are not going to see a very significant impact. Also, we are really in terms of the consumption slowdown because the interest rate is actually rising. Even if I really have to look at perhaps a 70, 80 bips on the higher side is not really going to make material difference when you are really looking at the medium term perspective. And let me tell you, we are not really for a long term that interest rate in India is really continue to go up. So it would just be a matter of maybe 1 year per se. And then we really have maybe, of course, would really start either hovering at those level or maybe really start coming down. Clearly, one reason why I really say this is going to happen because the cost of capital in India is relatively has always been on the higher side. And perhaps this government and the RBI on their own wisdom has actually figured it out that this could really be one region where perhaps they really need to do something to basically push that manufacturing sector. So hopefully, it's not that cycle would not really be a lasting cycle, and it would really be relatively shallow, and hence we don't really see a lot of impact. Of course, some bit of impact and volatility will always be ordered for the day.
Okay. All right, Niraj, we'll let you go on that one. Thanks so much for joining us on the show today.